Hello, my name is Yannick, and this is Financial Modeling 101. I just created a basic financial model for anybody that would like to use financial modeling to forecast or calculate their revenue. We've got a table of assumptions. We've got the units, price. I should put price per unit. Per unit. We've got production cost per unit. And we got wages, number of employees, admin costs, corporation tax. And here we've got our table, our income statement. We've got revenue, cost of goods sold, gross profit, and so on. So what we're gonna do is to fill out the assumption and do the calculation as we go forward. So you can see how it goes. We've got home here, we've got units. My first assumption is quite straightforward. We've got 10,000, we've got 14,000, and we've got 18,000. And the price per unit, the first year is £10. The second year is 15 and 15. I've already put the pound sign, so the cost per unit, each unit costs us £4 to make. We've got four all across, and we just copy and paste it here. And we've got the wages, salaries is a yearly salary. Let's make it a bit realistic. We've got £10,000 salary the first year. The second year we've got 12,000. The third year we've got £15,000. And the number of employees to do this job, we need, for example, 5 employees on each month. So we just copy this and paste that here. We've got admin costs. That's estimate to increase yearly by £1,000. So we've got 5, 6, and £7,000. And we've got the corporation tax. This is in the UK, so the current rate for small businesses or businesses that add this much turnover on a yearly basis is 20%. We've got 20%, and we've got 20%. So this is done. We can have it there as a block. This just be like so. All the blue are the assumptions. So you know if you want to change anything on the assumptions, you can just change it as much as you want. For the revenue, we'll see how much money have we made on the first year would be equal units times costs per the price per unit. This is we've got 100,000 and we just drag it through. We've got all the cost per goods sold. How much it costs us to do one unit is £4 here. And we've got this time number of units, and we've got the cost per unit, and the gross profit is the revenue minus the cost of goods sold. This is the gross profit. And I've added the margin so we can see the margin of the gross profit to the revenue and the margin of the operating profit to the revenue. So we've got this by the revenue, and we can drag it in, making percentage so we can see how much is the change over the years on the revenue. And then we've got the operating expenses. We've got the wages is 10,000 per employees, and we've got 5 employees. So we just take the information we've got, bar, and we drag it in. We've got the way. Oh, apologies. We need to do it on the wages. I'm doing it wrong there. This, tighten that. And it's gone. We've got the admin cost, which is pretty much here, equals. And we got the operating profit will be what we have minus sum of these two, and we've got the operating profit. The margin will be the same, margin to the revenue, and we drag it all and we make the percentage on it. We've got 5%, 42 and 43. Interest received, if there's any, we don't have any assumption for the interest received or the interest paid, so we don't need to put anything. We can just get rid of it for now because we're not using it. There, they're gone. There's no formula here, so we input all the formula. Profit before tax would be the operating profit because we don't have any interest received or paid. That's the operating profit. The margin's the same, so we don't need that because we already know what's the margin. It was in place if we had something, so we don't need to repeat it. Tax. On the tax, we have information about the tax rate, so we just need the value of the tax. If there's profit, we make it. There's profit on all the 3 years. We've got this times the tax rates, which is £1,000, and then profit after tax is that minus this, boom, and we've got a margin. We do the same margin as this to the revenue, and we drag it on. Whoops, drag it on percentage, and we've got pretty much everything that we need to know about this company or this business. And to see the changes as it appears, we're just gonna freeze the top bit so we can see, because when we drop down to the revenue, we can't see the assumptions, and if you want to make change and see it directly to be more practical, go to the views, we block this base, so at least we've got things so you can see exactly. If you put the change in the unit, let's assume we, instead of 10,000 unit, we produce 9,000 unit, we can see we've got a loss, and from the operating profit, the first year will be a loss. And if for any reason we got £9,000, but we price it higher, we price it to £12 per unit, we've got a profit. And we can see the sensibility, the sensitivity of the change in price and in the change in the number of unit. You can choose if the production costs change, for example, we'll find some more expensive, will cost charge us £6, and we see we've got a loss again. But if it goes to £5, got a profit. And with this, you can easily find out your break-even point on how much you need to produce and what price you need to put it, and it gives you a clear view on how profitable or a loss your business could be. Please subscribe and like if you like the video. I can do the spreadsheet is available for anyone that wants it, and I'll be uploading more videos with much more deep financial modelings and types where we can find out the NPVs and all the other IRR and all. Thank you very much for watching the video, and bye.